is on the podium. Let's go directly to him.
Rule 50% in the Commission regarding gender balance in the process of appointing panel members.
The start of vaccinations in many countries.
I have closed the bracket. Now regard to the youth. They were mobilized and they are ready to get into action with their capacity to innovate and their will to change.
In global gross domestic product for 2021 was
it is in this way that they could be break with the idea that the best are elsewhere.
Now 5.8% for 2025.5%. The SABC forecast for global growth in 2021 is now 5.8%. For 2022, we expect global growth of about 3.7%. Despite this more optimistic outlook, distribution of vaccines will be slow, contributing to an uneven pace of global economic recovery this year and next. Financial markets have generally improved in line with stronger growth and expectations that policy settings in advanced economies will remain accommodative. Capital flows to emerging markets increased in December and January. However, in recent weeks, renewed uncertainty resulted in more volatility in flows and currencies. This reflects considerable sensitivity to risk, particularly where economies fail to take advantage of improved global prospects or run large macroeconomic imbalances. Even though global policy rates are likely to remain accommodative, risk aversion will persist. South Africa's economy expanded by 6.3% on a quarterly annualized basis in the fourth quarter of 2020 and contracted by 7% for the year as a whole. The bank's GDP forecast for the first quarter of 2021 stands at minus 0.2%, down from 1% at the time of the January MPC meeting. With stronger quarterly outcomes for the rest of this year, the economy is expected to grow by about 3.8%. Getting back to pre-pandemic output levels will take time. While recent local lockdown restrictions have proved less constraining to economic activity, load shedding has been substantial and consumption moderated after December. Rising oil prices have increased the economy's total import bill, offsetting some income gains from a stronger terms of trade. Sharply lower public and private investment last year and continued weakness in 2021 will weigh on growth prospects. GDP is expected to grow by 2.4% in 2022 and 2.5% in 2023, unchanged since the January meeting. Overall risks to the domestic growth outlook are assessed to be balanced. Global growth, progress in vaccination, a low cost of capital, and high commodity prices are all supportive of growth. However, new waves of the COVID-19 virus are likely to weigh on economic activity both globally and locally. In addition, ongoing constraints to the domestic supply of energy and uncertainty about vaccine rollout continue to pose downside risks to growth. The large current account surplus at present reflects good growth and higher prices for exports, moderate prices for import oil, and very weak demand for imported consumer and investment goods. This surplus is expected to give way to a modest current account deficit as the year progresses. Despite recent volatility, on balance, accommodative policies in many advanced economies and the improved economic outlook will support global financial markets and strengthen international capital flows. This broad improvement in the global environment resulted in net capital inflows to South Africa in December and January, before giving way to net outflows in recent weeks. Although financing conditions have modestly improved and fiscal risk has eased, the yield curve for rand-denominated assets remains steep. Despite the generally favorable global conditions and considerable rand appreciation through the latter half of 2020 and into this year, the rand remains below its estimated long-run equilibrium value. Since the January meeting, the rand has appreciated by 1.3% on a trade-weighted basis. The implied starting point for the rand forecast is 14.96 rand to the US dollar, compared with 15.70 rand at the time of the previous meeting. Headline consumer price inflation averaged 3.3% in 2020. The forecast for 2021 is higher at 4.3%, and for 2022, slightly lower at 4.4%. The forecast for 2023 is 4.5%. Core inflation also averaged 3.3% in 2020. The core inflation forecast for 2021 is slightly lower at 3.3% and unchanged for 2022 and 2023 at 4% and 4.3% respectively. Oil prices have been revised up sharply in the forecast, resulting in higher petrol price inflation at 12.7% for 2021, compared to 4.4% at the time of the January meeting. Electricity prices are significantly higher at 9.7% for 2021, up from 8.1%. Expectations of future inflation have eased further in the first quarter of this year. Inflation expectation of households continue to moderate from quite high levels. Market-based expectations for short-term inflation are lower, but have increased for the medium and longer-term horizons. The overall risks to the inflation outlook appear to be balanced. A more appreciated nominal exchange rate in recent months and generally low pass-through is expected to continue to moderate some inflationary pressure. The committee additionally notes the significant, but likely temporary, reduction in medical insurance price inflation this year. While global food price inflation remains high, local food price inflation is slightly lower than previously expected and should remain broadly contained due to higher local crop production. Oil prices have increased sharply this year and are expected to remain at these levels over the forecast horizon. Electricity and other administered prices remain upside risks to the inflation trajectory. Although there are no demand-side pressures evident at present, higher growth in 2021 and no change in the potential growth rate, implies a narrowing of the output gap over the forecast period compared to the January meeting. Unless the risks outlined earlier materialize, inflation is expected to be well contained in 2021, before rising to around the midpoint of the inflation target range in 2022 and 2023. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. The decision was unanimous. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in each of the second and fourth quarters of 2021. Compared to the previous meeting, the shift in the rate path from the third to the fourth quarter is due to somewhat lower inflation in 2022. Monetary policy continues to be accommodative, keeping financial conditions supportive of credit demand as the economy recovers from the pandemic and associated lockdowns. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. Important macroeconomic gains could be realized by achieving a stable public debt level, increasing the supply of energy, moderating administered price inflation, and keeping inflation low into the recovery. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second M remains a broad policy guide, changing from meeting to meeting in response to new data, and will open up for questions that you should then post through the question and answer function, and the media team will then field the questions to me, and I will decide which one of the panelists will respond to the questions. Zianda and Saraya, are there questions coming through?
Yes, Governor. We've got a question from Claire Besseker. To what extent does the recent rise in U.S. Treasury yields and corresponding rise in local currency 10-year bond yields in SA pose a risk to SA's inflation outlook and threaten to complicate the conduct of SA monetary policy over the years to come? Miriam Issa from Finwig. How big a risk do you think that a possible pickup in U.S. inflation and Treasury yields pose to currency and bond levels in SA and other emerging markets? We've got a question from Dumazim Konto. As Eskom receives its tariff increase approval from NESA, what does this for the bank's inflation outlook? I'll stop there for now, Governor.
Thank you very much, Claire. The rise in U.S. treasuries and the rise in South African government bonds don't pose a risk to inflation per se. If anything, a rise in bond yields could be deflationary, or could actually bring down inflation, because it might constrain demand. However, the rise in the U.S. treasury yields mean that global financial assets are repriced. And as global financial assets are repriced, bond yields in South Africa, as you have seen, would also rise to try and maintain the differential between the US rates and the South African government bond yields. These are all driven by the forces of demand and supply of South African government bonds and of US government bonds. So to the extent that the bond yields would move in tandem with the US Treasury yields, it would mean that it compensates investors, and that could be a dampener on the possibility of a depreciation of the currency. But as this repricing takes place, that is the channel that you would expect, that even the South African exchange rate, the rand, would reprice, because the US is growing, and with higher bond yields, that means that the differential in terms of growth and in terms of the bond yields is attractive for the US. Let's not forget that the US have got significant borrowing requirements, and the bond yields might be responding to those to that increased financing requirements from the US, which then links up to what Miriam was asking about the pickup in US inflation. And part of the response of the US bond yields is that the market is expecting that inflation would pick up. But as you might have heard from the Fed, and the most recent forecast of the Fed is that inflation could pick up, but it will be just over the 2%. And on average going forward, that it will still be within the ballpark of what the US Fed actually targets. To the extent that US inflation goes up, and to the extent that we are able to contain our own inflation, that means that the inflation differential between the US and South Africa is reduced, which would mean that South Africa is actually gaining in competitiveness. So there is nothing virtuous about having an inflation that is higher than that of the US. If ours is contained and the US is going up, that would mean that the differential does come down. Dumasi, your question about the electricity prices, we have in our forecast an assumption of electricity tariff increases of 9.3%. If the tariff increases are more than that, we will have to redo our forecast, and that is why we have highlighted electricity prices and other administered prices as posing a risk to the inflation outlook. Thanks. Back to you, Zianda.
Thank you, Governor. The next question is from Ed from Business Maverick. Does holding the rate steady again help to inject some certainty into an uncertain economic environment? Miriam Issa from Finwick. How big a risk do you think the electricity supply constraints pose to your economic growth forecast for this year? Governor, we have 3 questions from Funeko from Reuters. Of what significance is it that money markets, that is the JBAR, has been trading above the repo rate for most of 2021? A year since the pandemic struck, how do you rank the effectiveness of the extraordinary monetary policy measures taken by the MPC? How can you offer as evidence to the public that the steps you took went far enough? Governor, last month you spoke about the budget, about how monetary and fiscal policy had coordinated, but that this had perhaps reached its limit. Can you explain this? We have more questions, Governor. Can I read them now?
Okay, I suggest you read them. The chances are that I'm going to give them to the other panelists. So let's read them so that they can gather their facts, because I'm going to give them to the panelists.
Okay.
Let's take 3 so that we can, 3 more.
Okay, perfect. Pranisha from Bloomberg says, how much longer does the SARB plan to be actively involved in buying SA government debt in the secondary market?
That sounds like it's Fundi.
It's Fundi.
Sounds like it's Fundi, yeah.
And Dumazi, it's been a year since the economy was plunged into lockdown. How effective has the SARB's loan guarantee scheme? It's a similar question to what was asked earlier regarding its effectiveness to help businesses survive the pandemic. So our measures.
Loan guarantee scheme. Sounds like DG Naidu.
DG Kupen, yes. Those are all for now, Governor.
Okay, I will find one for Rashad, don't worry. Ed, you asked the question about to what extent the holding of rates brings certainty. Certainty is brought by the broad policy settings in the South African space. That is what brings a certainty. Certainty about the future of rates is not something that is really part of the big equations in driving investor sentiment. What matters from a monetary policy perspective is that we have a monetary policy anchor. And our monetary policy anchor as a flexible inflation target is within the inflation targeting framework. And it is that we would like to see inflation expectations anchored closer to the midpoint of the inflation target range. And over the forecast period, we expect inflation to be within that ballpark of 4.5%. Sometimes it might be marginally lower, but that is where we would like to be seeing inflation. And that is what brings certainty. The fact that we expect inflation to be contained is what will provide investors with the certainty they need in order to invest. So the certainty comes from the central bank containing inflation rather than fiddling with interest rates per se. Miriam, electricity supply. Last year, as the economy was just beginning to recover as a result of the relaxation of the lockdown, we experienced electricity supply constraints. I've got no doubt that if we didn't have load shedding as the economy was emerging from the lockdown, this economy would have been much stronger than it is at the moment. And it is for that reason that we highlight the risk to the economic growth outlook as being the certainty of supply. We can't say to you for sure this is the extent of the impact because we are never sure when we are going to have load shedding or and for how long we are going to have that load shedding. Mfuneko, the issue of the JIBA trading above the repo rate, that is what we expected should happen. There were times then it traded below the repo rate, which in itself might have suggested that the market was not functioning as efficiently as we expected it to be. That it had eventually now started to trade above the repo rate, that basically means that the money market is actually functioning. And I'm sure DG Chasibana might want to add to that. How effective have been extraordinary measures that had been taken last year? We didn't take extraordinary monetary policy measures. The monetary policy adjustments that we made were done with scale, were done with speed to adjust the policy rate because we still had the policy space to be able to act. And the fact that inflation was on a declining trend at the time gave us the policy space to be able to provide support using our key policy instrument, which is the repo rate. And let me at this stage repeat what I had said before. Lower inflation begets lower interest rates. Higher inflation begets higher interest rates. And so we were able to provide the support to this economy by adjusting the policy rate precisely because inflation was contained and on a forward-looking basis was within our preferred target of the midpoint of the inflation target range. The other measures that we took, like the bond purchases and extension of the repo facilities, had to do with market dysfunction and market dislocation. And they were being deployed to the extent that we saw dysfunctioning in the market. The South African markets seem to have been functioning well over the past 10 to 12 months and have not required us to step up on the measures that we have taken to mitigate against market dysfunction. And so we think that they had been effective in that respect. There were regulatory relief measures that were taken, and those were to enable the banks to continue to supply credit. And we think that they had been effective. And maybe DG Naidu might want to add something there. Mfuneko, I'm not sure if you had heard me properly when I talked about monetary and fiscal policy at the time of the budget. We are constantly in conversation as the central bank with the National Treasury, as the Constitution enjoins on us that there must be regular consultation between the central bank and the Minister of Finance. And to the extent that you have had a fiscal consolidation path that had been announced, it reduces the risks in the South African economy and thus brings down the country risk premium. The country risk premium is an important component of the neutral real interest rate. And to the extent that the fiscal policy settings bring down the country risk premiums, it then brings down the neutral real rate. And by bringing down the neutral real rate, it means that it also brings down the cost of capital in this economy and is as such growth positive. And that is the extent that we talked about being the interaction between fiscal and monetary policy. Monetary policy is focused on protecting the value of the currency, and that we have done successfully by bringing down inflation and making sure that inflation is contained closer to the midpoint of the inflation target range. And by being contained at that level, it meant that we were able to provide policy support to households and firms through our key instrument being the repo rate. DG Chasivana, bond purchases, and anything you might want to add on the JIBA and the repo.
Thank you, Governor. Let me start with Mfuneko's question. So Mfuneko, I think the most important thing to remember is that the repo rate is the main reference interest rate in the economy. So when market participants then lend funding to each other, they would generally price, as the governor has indicated, above the repo rate. So the banks come and they borrow from the SARB at the repo rate, and they would normally lend to each other above the repo rate. Generally, the spread between the repo rate and JIBA has been around 30 basis points. It's currently around 19 basis points. So what you are seeing is not an anomaly. Turning to Pranisha's question on the bond purchases. So when we made the announcement around the bond purchases, we signaled that this is part of our monetary policy operations toolkit, meaning that we were purchasing bonds such that at a later date we might be able to sell the bonds. So it's part of our monetary policy portfolio. But at the same time, because there was a dysfunction in the government bond market, that intervention of purchasing government bonds then played the role of providing the additional liquidity that was needed in the market at the time. So, Pranisha, we did buy bonds, government bonds in the secondary market during the course of last year. But if you go through the SABC financial statements, you will see that the activities have slowed down since November last year. However, we continue to watch what is happening in financial markets. And if we do see signs of dislocation, any sign of stress within the government bond market, we stand ready to intervene as required. But as we have highlighted in the past, this is going to be part of what we will be doing as the central bank going forward. But we will not only be purchasing government bonds if the need requires us, is for us to drain liquidity from the market, we will be also selling the bonds back in the market. However, that is not the intent right now. Currently, we are monitoring what is happening in the market. And if we do pick up signs of stress, we will respond appropriately. Thank you, Governor.
Thank you, DG. DG Naidu, if you can talk about the loan guarantee scheme and anything that you might want to add on the regulatory relief measures.
Sure. Good evening, good afternoon, everyone. Thanks, Governor. The loan guarantee scheme must be seen in the context of broader policy measures. One was the reduction in interest rates, two was the injection of liquidity, three was the purchase of government bonds, and four was the significant regulatory relief we provided through lowering various ratios. The combination of all of those policies certainly helped banks to lend. It certainly helped to keep credit flowing. And we do know that there's been a significant amount of relief provided to individuals and corporates.
All right, we're going to come out of that MPC press briefing. Of course, rates remain unchanged with the repo rate at 3.5% and the prime rate at 7%. After the break, we'll get to some analysis from some experts.
To go deeply negative from two questions from Hilary Joffe from Business Times. Was there any discussion of a rate hike? Her second question is the MPC concerned at all about the prospect of a negative real policy rate? A question from Funeko. Do you believe that the local banks have reached the limit of government bonds they can safely hold? Another question which came via the webcast from Atwell, Alliance News. Why is the bank still projecting rates hike in the second half of this year when inflation expectations are low? The market expects rates to go up only from early next year, and growth is still weak. Thank you, Governor. The last question is the one that DG Naidoo referred to on Lancaster.
The last question is a very interesting one because it says that why are you expecting rates to go up? And Claire and Hillary say, how long would you tolerate negative real interest rates? Now you clearly can't have you can't have both. But let me deal with that in totality. Firstly, the forward rate agreement market is a very active market. And it's not a very accurate predictor of what will happen to rates in the future. I have not watched the screen now after we decided that we are keeping rates the same. You might find that they had changed. But having watched that market, you could wake up in the morning of the MPC and the FRA market expects rates to go up. And by the time you get to the MPC decision, you find that they expect that rates to go down. So they are very volatile. It's an important indicator for us to watch. It tells us the extent of domestic financing conditions and what the expectations of the traders are. That is different from what the expectations of economists are. And we watch those, but we do not quite follow that. And we think that the forecast that we have put on the table is a credible one, given the risks that we might be having. And the question about our tolerance of negative real interest rates, you know, this is the point that we've been making when people ask whether we have done enough or whether we are doing enough. This is exactly the point, that we have done so much that real interest rates on a forward-looking basis are still marginally negative. And so this is providing support to the economy. It is in the accommodative space. And that is why even our projection model is then saying that it's the path implied in the model is that there would be two hikes of 25 basis points each in subsequent quarters. It is precisely because it is factoring these kinds of things. We wouldn't be alone in, by the way, in having a negative real interest rates, and I think that you see that across the global universe at the moment. We are still in comfortable space. Other countries are having negative nominal rates, and we are not having that at the moment. Rashad, you probably might want to add something to what I have just said here, but let me go back. DG Chasivana, is there anything you would like to say about the FRAs and that seems to be where you like playing, and also the exchange rate being resilient, and whether it no longer seeming to be a proxy for emerging market risks, what this might mean for inflation going forward.
Okay. Thank you, Governor. So I think that you have answered the question adequately on the forward rates agreement. That market is quite volatile. And so I would request colleagues to also check what happens after this meeting. But it does indicate, as Claire correctly reflects, it does indicate the market's expectations around rate hikes. And as the MPC, we look to the market indicators to learn about what it's telling us about what market participants expect. But that's not the only source of information that you would look at as the MPC. Also recall that the market also receives guidance from the MPC. So it's not a one-way street that you would say, well, if the market expects this, then why is the MPC responding in a certain way? And we utilize the statement to highlight what our view as the MPC is on how we see the balance of risks. And that's not necessarily between ourselves as a bank and different market participants. So very important to keep that in mind as well. Regarding the exchange rate, a number of factors do affect the exchange rate. We reflected in our statement about the fact that there has been volatility, quite a lot of volatility recently in terms of, and that has affected emerging market countries. But what we have found over the past year is that some exchange rate movements reflect global financing conditions. They also reflect what is happening in terms of investor sentiment. And investor sentiment is also driven by how investors perceive the risk related to a specific countries or a group of countries. So there is some level of differentiation that takes place. We have seen the South African rand being affected in a very similar way to other emerging market currencies, but it's not going to be exact because there are certain circumstances that are quite unique to South Africa that would also have an impact on the currency. That doesn't mean that the rand is no longer a proxy for emerging markets, but it simply reflects that while South Africa is an emerging market country, there are also certain factors that are unique to South Africa. And as you have seen also, the decisions taken by emerging market central banks have varied over the past year. The decisions taken by the fiscal authorities in different emerging market countries have also differed over the past year. So it's the combination of these factors that would have an impact on the exchange rate. Thank you, Governor. I don't know if Chris would like to add to that.
No, I'd like to move to, no. Rashad, is there anything that looks like Fundi covered what I thought you might also end up covering, unless there's something missing? Okay. Rashad?
I can add one or two things. I mean, I think that there's a lot of interest in our tolerance for negative real interest rates. And I would just add one or two things to what the governor said. I think that there are two important elements to a negative real interest rate. The one is the negative real interest rate in its own right relative to historical patterns. That gives you some sense of where the real interest rate is and the level of accommodation. The other side is the negative real interest rate relative to what we think a neutral real interest rate in the economy is. But I think that this negative rate shouldn't be seen in isolation to two things. One is slack in the economy, or what we call output gaps. The other is what evidence we see and what's actually going on with inflation. And I think that we would be more concerned with negative real interest rates if the economy begins to pick up much quicker and the output gap is closing. That would mean that we would be more cautious and monitor probable increase in inflation in a more kind of serious way. So I think so the tolerance really depends on our assessment of what are the upside risks to inflation as we go along with the negative real interest rate. Governor, there was another question we missed. Chris is probably better able to answer it, but I can attempt. Was what is the impact of energy constraints on growth? I would just say that there are also two sides to this. The one is, you can put a magnitude to it. We can say, well, if our forecast is, 3.8, and we think that energy is more of a constraint, depending on how you model it, it could take off, a couple of decimal points off the growth trajectory. But I think that the more important question about energy constraint is that current growth numbers from which we project further embed in themselves some of the energy constraint, although that constraint becomes more binding when the economy accelerates or picks up. And that's where really you find that it will become more constrained. Obviously, currently it is partly a constraint. We know there are all sorts of load shedding and so on. But in the way that you model the numbers, you can make a number of assumptions and get a series of different numbers. But we have to be realistic about where we think our growth trajectory is going to be and how it's going to be a constraint. Thank you.
Chris, do you want to add anything on that electricity supply constraint?
Rashad answered it perfectly.
Good. Okay, that brings us to the end of the MPC press conference, but there was a question about Lancaster that I would ask DG Naidu to deal with.
Thanks, Chair. Chair, in fairness, there was also a question from Funeko about our tolerance for banks holding government bonds. So let me just deal with that quickly. In a recession, in a crisis, it is quite understandable, predictable, and in some ways even desirable for banks to increase their holdings of government bonds. You often have a rise in deposits, an increase in household and corporate savings, a fall in corporate investment, and at the same time, a fall in the demand for credit. And so banks have got additional liquidity, and buying government bonds, lending to government is one thing that they do in a crisis. This is both understandable and, I say, in a crisis, even desirable, because it helps government to finance its deficit. It is not something we would want for the long term. In the long term, we don't want a banking system that collects deposits from households and only lends to government or mainly lends to government. We hope that demand for credit from the private sector would pick up as the economy accelerates, and that government's borrowing requirement would fall as the economy accelerates, with quite a neat sequencing of, in some ways, a withdrawal from the banking system in the government bond market. Hopefully that will happen automatically, and I think there are already signs that that's beginning to happen as the banks have actually tapered off their bond purchases in the last couple of months. Chair, on the Lancaster one, yes, we have been served notice that Lancaster 101, a company, is challenging some of our decisions on exchange controls. We are taking the matter very seriously. We have signaled our intention to oppose their motion, and we will file papers in court to that effect, Chair. Thanks.
Thank you very much. Zianda, that concludes the questions you had given to us. Back to you.
There are no further questions from my side. Thank you, Governor.
Thank you very much, everyone, for your participation. You come through. Bye-bye, good people. We were waiting for you, Tony. You were hiding. Okay. Maybe it's because I'm speaking too fast.
We're getting compliments. We're getting compliments from the media. Everyone says the feed was great.
Okay.
Okay.
It's Tony the perfectionist who's worried, but sort it out with Zoom.
Okay, so I can go back into my comfy clothes.
No, Miss Winnie. We have a dry run now. I'm joking. I'm joking. You can.
Okay, everyone.
Okay, bye.
Thank
right.
you.
Okay, bye.
Thanks, Tony. Yeah? Well done.
Hey, baby.
How?
Who was that?
Somebody's babe complimenting you. Okay, that's it from us. Thanks, T.
Okay, can we just log off, everyone?
Are we logging
Can we
off?
close the meeting?
Okay. Tony, you can close it. You can shut it down. You can close the meeting.
Thank you. Yes, please end.
Cheers.